Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a rainy Redmond, Washington. This is a special all-mailbag edition of our show. We love to do these shows regularly as much as we can because we get so many great questions through our mailbag. As a reminder, we love hearing from you, particularly questions that you're running into as you are trying to use the technical analysis toolkit, as you're trying to use the Stockcharts platform to navigate these markets with the S&P, playing around with that key 5,000 level. So make sure you email us your questions. Continue, keep them coming. thefinalbar@stockcharts.com is our email. And let's get right to question number one. Dave, how do you identify a bull flag or a bear flag, and how should they be traded? You know, we talk randomly about a lot of different price patterns. I often refer to cup and handle patterns, or what you might call a cup with handle pattern. Head and shoulders top patterns, inverted head and shoulders bottoms, and then things like triangle patterns and flag patterns and pennants and all those other ones. The good news is, if any of those patterns that I just mentioned do not ring a bell for you, we have a free part of our website called Chart School, which is really designed to help you understand these patterns. And I will tell you honestly, a couple of years ago, as I was first learning technical analysis, I had a couple of things that I used to really learn them. Number one, I read the book by John Murphy, Technical Analysis of the Financial Markets. I would start there, and we certainly have it on the Stockcharts store, on our bookstore. So make sure you pick up a copy. Start with that. It's an easy read and really introduces technical analysis at a very high level. I then went through the CMT program, which is a way to learn really a lot of details about it. And as I was going through the CMT program, I used the Chart School on Stockcharts.com to really understand and see way more examples than I could get from textbooks and from the required readings. So if you go to the little magnifying glass at the top of our website and type something like flag or pennant or any of the other price patterns that I mentioned, you'll get to Chart School. And this is a particular article I would encourage you to go check out, which actually goes through flag and pennant chart patterns. And just to quickly explain what a flag pattern is, which is kind of down here. A flag pattern is when you have a big move in a stock, and then you have a brief pullback, right? And what makes a flag is that it's a parallel move and it's a counter trend move. What I mean by a parallel move is it's kind of a little trend channel, right? So the trend overall here is positive, right? It's bullish, but as the stock went higher, we had this little counter trend move, right? So it's going against the primary trend, and it's a parallel channel or a trend channel of lower highs and lower lows. The trigger is what you're looking for, which is when it breaks out of that pattern to the upside. What a flag pattern and really a pennant pattern really telling you is you've had a big move, now you're in a pause, right? You've hit the pause button on your video and you're waiting a couple of minutes, and then you hit play again and the uptrend resumes. It literally is like a pause in the trend, and a pennant means there's a consolidation. A flag pattern means it's a downtrend channel, but in either case, breaking above that upper trend line is the trigger. That's the most important signal. So you can find flags like this by looking for stocks that have had big moves and then start to have some pullbacks. And recently here in January 2020 and February 2024, we've had plenty of examples of short-term flag-like patterns. What makes it a flag is that trigger. So as you go through this article, make sure you read about the trigger, which is when you actually break out of that flag pattern. That's the signal you're really looking for, and make sure you validate that breakout before you consider any sort of long position. So great question there. And that's a bull flag. Bear flag is basically everything I just said flipped upside down, and there you go. Make sure you use Chart School to learn more about those patterns. Next question, can you explain why there are gaps at the market open? Why don't they open at the previous day's close? So here we're looking at a chart of Apple, and to be honest with you, price gaps happen on a lot of equities, and price gaps happen basically when there is a change of some sort between one day's close and the next day's open. Looking at the chart of Apple, here's a gap that I'll focus your attention on. We're going to zoom in maybe to the last year, just to make it a little better time frame to consider. Here's that gap that I was pointing at earlier. So think about what would actually happen here, right? So day one, we closed around 190, we'll call it, and the next day we opened around 185. So how could that happen? So what you have to remember is U.S. equities trade between 9:30 and 4 p.m. Eastern time. Now there is a pre-market session, and there's a post-market session, an after-hours session that goes to about 6 p.m. Eastern, a pre-market session that goes up until 9:30 a.m. But those are a lot less heavily traded. The volume's a lot lighter, a lot less participants. A lot of institutions can't really go into that session, and so really focusing on the main trading session. So what this is showing you is that the market closed at a certain point. Now, the next morning, A stock like Apple or a stock like IBM actually has an official opening price set by the exchange. Now, back in the day, a couple decades ago, when things were traded on the floor of a physical exchange, talking with Jay Woods, who we had recently on our show again, he would tell you that basically the floor broker, right, whoever was in charge of that particular post where those stocks were traded, they would actually be required to set an official open. And they would gather a bunch of indications from different brokers on the floor, and then they would set an official opening price, and that would kick off trading. That's still done, but in a much less manual and much more computerized version. So what happens is the day closes at 4 p.m., but between that close and the next day's open at 9:30 a.m., a lot can happen. There can be macro news like a geopolitical event, a war breaking out. There can be some big economic data that often will come out before the open at like 8:30 Eastern, like a jobs number, inflation number. Could be earnings, which is one of the most common reasons why you see price gaps on a chart of something like Apple. So what happens there is after the market closes, a company reports earnings right after the close, maybe before the open the next day. And then when they go to set that new opening price, basically what they're getting when they look at the sort of open orders and the indications on the floor and from different brokerage platforms, they can see, all right, this is where the stock should open. And then from there, the market is really free to go all over the place. And that's why you often have an initial open and then a stock will move very quickly after a gap, because now that the market is reopened at its new price, then it's a very different question, right? Because instead of saying, do I want to own Apple at 190, you're now asking the question, do I want to own Apple at 185 after this new news flow or this new news event has actually played out? So stocks close every day and then they open the next trading session, and things can happen, news can occur, events can happen, and that next open is where the market is once again free to set that price. So that's why gaps actually play out. You won't see price gaps on things like cryptocurrencies because they trade 24 hours, on things like indexes because the opens are actually much more calculated, but with individual stocks you will find them a lot, and that is one of the risks of trading individual stocks, but hopefully worth it if you know what you're doing. Next question. Dave, how do the charts change when inflation is taken into account? This is a very interesting question. The short answer is not much. And what I mean is, your question was, how much do the charts change based on inflation? The answer is, to be honest with you, not a whole lot, right? There are certain things that you include when you're creating a price chart, right? The actual trading, right? The actual price action, of course, dividends, splits, capital structure changes on the equity. These are things that you actually have a decision in terms of how you want to incorporate them into the chart. Now, a platform like Stockcharts, we answer some of those questions for you based on what we feel is the right way to do it. So we always adjust for splits, because I've yet to meet someone who thinks, not adjusting for a split is a good idea. It just is. And trust me on that. Dividends are a little different ones. We actually, on a platform like Stockcharts, we now give you the option to select or deselect. Do I want to adjust this price data for dividends? Because that will, about once a quarter, change the value of a stock based on the fact that they pay a portion of the value out as a dividend. Now, inflation is a little different one. What you have to remember is inflation data is updated once a month. You get the CPI number, which is the main gauge of inflation. So you could make some adjustment to your stock based on the changes in CPI. Most people don't ever do it. You think of things like inflation and interest rates and those sort of things that impact the value of your dollar, right? If Apple is trading at $900, how much is that $900 actually worth? That's like a separate question you want to ask yourself when you're thinking of the purchasing power of your dollar. If you want to get a sense of how CPI has changed, we actually have CPI data on our platform. If you do $$ CPI, you'll see some of the CPI data points that we use, and this main one is the one you want to probably look at. And if you look at a monthly or a year-over-year percent change, a rate of change, you'll get that actual CPI number, that 2% target that the Fed is looking for. That's a year-over-year change in the in this series, the $$ CPI. But how much do we actually change the charts? Not much. I would encourage you to analyze the charts based on the price action of that individual stock. Think of things like interest rates and inflation and other sources of income for a stock as all other things to maybe inform your decision making about how much you want to be buying and selling individual stocks, less about how you would trade an individual name. But really interesting question about how to think about inflationary impacts. Next question. How do you calculate daily price bars for Bitcoin as it never stops trading? how does that relate to ETFs like IBIT? That's the new iShares ETF tracking Bitcoin. So what's interesting is you have this problem when something trades 24 hours. I mentioned with the chart of Apple, what's great about it is you still have, for now, at some point maybe we trade stocks 24 hours. I mean, I hope I'm not trading actively when that happens, because that sounds like a lot of work. And there's nothing better than the market being closed and knowing that you just have some free mental space until the market's open again. I would tell you, as someone who has followed and written about and talked about the markets for a number of years, that time after the close is this magical time to take a deep breath, to celebrate the end of a trading day in however way you want to do that, healthy or unhealthy, but it's certainly a good mental break. So I'm not looking forward to that, but something that you find with cryptocurrencies, and not just cryptocurrencies, right? Globex futures, which would be something like crude oil. There's a Globex session that's 24 hours. Currencies of any sort, like the Canadian dollar or Swiss franc or British pound, those are actually traded in 24-hour periods as well. Cryptocurrencies are unique in that they trade all over the weekend. So it's literally at all points is Bitcoin technically trading. So there had to be some way of clarifying a close. Otherwise, it's just a bunch of gibberish on a chart over time. And how do you actually create indicators? So what the powers that be, not me, sort of came up with was to use a technique that's actually used in the currency markets pretty well, which is to use the closing value based on a 24-hour period, and it's the UTC time, or sort of the Greenwich Mean Time, if you're old enough to remember when it was referred to that way. I'm going to go to just a shorter term chart, just so we can see this. Let's say like 6 months of trading here. All right, so you can see these individual price bars. You'll notice there are no gaps on the chart of Bitcoin because, again, there's literally a split second between one day's, quote unquote close and the next day's open, all in air quotes, because it really isn't a close and an open. That close is just meant to take a snapshot every 24 hours and have a way of identifying, okay, that was the end of the period, and now let's take another 24 hours into account. And that's kind of how you do it. So if you look, the timing that it's quoted is often quoted in UTC. So for here on the West Coast, it's basically our local time plus 8 hours. If you're in the East Coast, it's local time plus 5 hours is sort of that time that it's quoted on. So it's saying 8:46 p.m. UTC time as we're recording this particular broadcast. So IBIT and other ETFs based on this are not trading 24 hours. They're actually trading in the regular normal session as other ETFs would be. So when you have an ETF that's derived from an underlying product, they basically have an opening price that's tied to the price of the underlying asset, and also involves things like premiums and discounts. So it might not trade exactly to the spot Bitcoin, but ideally very, very close to it. And then trading is open from there. So that's how something like Bitcoin is actually categorized in days. It's an imperfect thing because there's no great answer, because there's no hard open and close. And this is an issue technical analysts have dealt with for quite some time. This is the best we can come up with, is pick a time, consider that the close, and go from there. So that's what we do. Next question. You showed an S&P chart this week with decelerating trend lines. What's the significance of this? I think you're talking about my daily chart of the S&P 500. When we're looking at the chart of the S&P earlier this week, and through the course of this week, we really talked about this particular set of trend lines. You described them as a decelerating trend line. I think that's fine. You could call this like trend fan lines, and there are different ways to sort of describe it. But decelerating trend lines is kind of how I would describe it as well. And what that means is, a trend line for me is basically a visual representation of the pace of the move, particularly when you have a log scale chart, which I pretty much always use in my own work and certainly on the show. Basically, a certain percentage has equal treatment across the y-axis, and that's why we use a log scale chart and not a traditional arithmetic scale where $100 or 100 points is the same up and down the y-axis. You do that so that percentage moves have the same representation on the chart, and for anything over a longer period of time, that's really a more accurate way of representing the pace of a move, because a consistent percent move is kind of what you're trying to define here. So a trend line that I've drawn off of the October low that I'm connecting to the December lows basically is a trend line. And for me, when I draw a trend line like this, I'm saying, here's the pace of the S&P's rise off the October low. And when that trend line is broken, that tells you that something's changed, what I've called a change of character. And sure enough, that happened in mid-December, which was the end of this initial thrust off of the October low. We then into really a 6-week period of more sideways price action of equal highs and lows, sort of a range-bound pattern before in mid-January we broke out of that pattern, resumed this uptrend. So once we broke out of that consolidation, I drew a new trend line from the same October low and now connecting it to the January low. So, in some ways, this is one of the easier charts you're ever going to see, because once you have a trend line that has 3 different points that are connected independently, which we do here, you just sit back and wait for that trend line to be broken. I review this chart multiple times every day. At some point, we will close below that trend line. I tell you when we do, I will come on this show and I will tell you the green trend line has been broken and here's what it means. And what it means is, at best, you're looking for some sort of corrective sort of consolidation phase like we saw in December to January, or at worst, there's a big rotation lower like we saw in August of last year. Tells you to be prepared for further downside. In either case, think about potential levels of support, that line in the sand, at which point you want to really start to get defensive. So that's the idea of decelerating trend lines. It tells you that the pace of the trend has changed. Make sure you update your trend lines to the new definition of that trend and be looking for a break of that trend line. Next question, how would you label Hershey's, that is, as an inverse head and shoulders pattern? Really good question. Let's go to the chart of Hershey's here. So my short answer is, yeah, and Hershey's actually pretty busy today. You can see it's kind of chopping around here, going through earnings season. I feel like I'm emotionally prepared. Most charts can get super whack-a-mole busy around an earnings date, or if even a company, even if they're not reporting earnings, a company within its group reports earnings, and something can move very quickly. This actually isn't an earnings-related move. They're reporting here in no, it actually is, right? February 8th. So right, this is earnings. It's a big move, kind of to be expected. What you're talking about with the inverse head and shoulders pattern, I would 100% agree, and that's this pattern that I'm highlighting here. An inverted head and shoulders pattern happens after a downtrend. It happens at a major low. We have a low price, and then you have higher lows on each side, right? So there's your head. Think of someone doing a headstand or a handstand. There's your head, your left shoulder, your right shoulder. And that's what sort of defines the inverted head and shoulders pattern. Now, the trigger, right, the most important thing to look for is what's called the neckline. And that's where once you identify the head and the 2 shoulders, you draw a trend line connecting. There's interim highs in this case, right? So the peak between the head and the left shoulder, the peak between the head and the right shoulder, there's your trend line, and that's basically called the neckline. And when you get a break out of that neckline, that suggests that the trend is changed. Now, another thing which the early textbooks really didn't talk about, but I think I'm okay with, is using a horizontal line. And my guest last week, I want to say, Jay Woods, or when he was on the show recently, we talked about this name and actually talked about this pattern. And he actually drew a horizontal line, which I don't have a problem with as well. That's really more thinking of it in terms of particular price levels. So if you take that left, the high between the head and the left shoulder, which is here around 198, basically draw a horizontal line. You can see we tested that resistance about a week and a half ago, and then now today, looking to break above there. What you look for is a close above whatever resistance level you've defined, and then for some additional follow-through indicators indicating the buyers are actually coming in. So I would label this a head and shoulders pattern. I would caution, a lot of people start labeling it as that pattern when the right shoulder is kind of happening. What you have to remember is until you break that neckline, it isn't a confirmed head and shoulders or inverted head and shoulders pattern. Now, if any of those details I was talking through kind of went over your head and you're not as familiar with them, great opportunity to use our chart school portion of our website. Just search for the keywords head and shoulders, and you'll find some articles that show some really good examples, how to identify the neckline and what sort of trigger you might want to be looking for. Next question. Meta's earnings report last week followed a very similar pattern to 2023 when a 10% decline followed. Do you think a repeat is in the cards? We had a great guest this week, Danielle Shea. He really specializes in earnings plays. I wish I would ask her this question, to be honest with you. But it's a really interesting one. If you look at the chart of Meta, and we're looking at the last 2 years, you can see, we mentioned gaps earlier. About every 3 months, you see a price gap for Meta, and that's because of earnings, right? They just reported last week. It was a 20% update. It was a big double-digit gainer as it closed, just below 400 on day one and opened around 460 the next morning. That's how significant of a move earnings can be, and ended up closing even higher than that through the course of the trading day. So gaps happen, and what you're asking about is because we reported earnings last week, that happened very similar to that in 2023, and then we had a 10% decline. I think you're referring to this point right here. We had the gap higher in February, so it's the same reporting month as we saw here. We gapped higher, things seemed really good, but then we drew down. Now this little move doesn't look like much, but remember, this has been a big gainer over the last 12 to 18 months. So this move right here is about a 10% haircut, if not a little bit more, going from around a high of just under 200 to a low around 170. So that was a pretty big swing over about a 3-week period. Now, the uptrend eventually resumed. And I think that's what's important is as you take a step back, once we traded lower, we never really filled that gap completely. And we did make a higher low, which is why when we do gap and you pull back, look for that higher low as maybe an indication that buyers are starting to come in again. But your question is, should we pay attention to this? I don't have a problem with that. What I would say is I would have a problem that is of assuming because this happened one other time, this is probably going to happen again. I think a lot of times we fall into that trap of seeing one other historical analog or historical example and think, all right, well, this looks similar, so it's probably going to be the same. If you told a statistician, I'm comparing right now to one other observation and then drawing a conclusion, they would probably laugh you out of the conversation because statistically speaking, that's not really relevant, right? If there's no guarantee that one other observation would have an impact on this next one. But if you see a pattern of this company tends to beat earnings, this company tends to be bid higher going into earnings, it tends to pull back after an earnings release, which we've seen actually many times with Meta. Most of these times where we had these gap higher, we've actually pulled back in some smaller or much larger way. So that is a repeatable pattern that I think you should definitely take to heart. So, does that mean we have a bit of a pullback here? I think potentially, absolutely. And it's not just about that. I think the fact that names like Meta have already had incredible runs, even going into earnings, right? January was already pretty strong before Meta gapped higher another 20%. So I'm concerned about potential downside and giving back some of those recent gains in growth stocks like Meta. Great question. I hope that helps you understand earnings and movements relative to that a little bit better. Final question here for the episode. Dave, you often show charts just breaking out. How do you find these charts? Really good question. And it's funny, I've talked with Grayson Rose. We just did recently our top 10 charts to watch for February 2024. And I think we might have talked a little bit on that episode, but I don't remember specifically about how we actually find these names. I would encourage you to use our scanning engine. I will tell you exactly how I find names that I highlight on the show. And again, doing a daily show, you're always looking for things on the move, things fluctuating. And as an individual investor, you're probably doing something a lot like that every day or every week. So what do you do? A couple things that I look at. Number one, I keep it super simple. So I'm always looking for things that are just moving, right? What's actually gapping up? What's gapping down? What's had a significant move? So, this week, names like Disney, Monolithic Power, names that are gapping on earnings immediately pop up onto your new swing highs list and your new swing lows list, or what we call our market movers list. These are stocks just having a big move on a particular trading day. I would encourage you as a Stockcharts member, which of course you all should be, make sure you customize your dashboard and include things like the market mover little widget, because this will tell you is how, which stocks are actually moving higher, which ones are moving lower. Make sure you're familiar with what's happening on these charts. Click on the charts, drill into them a little bit further, see what has happened leading up to today. Remember, today doesn't just happen in a vacuum. Things have been happening for quite a bit on a chart like PayPal, and this gap lower is just the latest move among many. So think about the longer term trends. Think about the shorter term dynamics today and how that fits into the bigger picture of what we call the primary trend. So that's thing number one that I do, or trick number one that I do, is use the market movers and just pay attention to the group of stocks, the universe that you're interested in. Make sure you identify those names that are moving a lot because something's happening and you probably want to be familiar with it. Second thing I would do is use the scanning feature, and you alluded to this in your question. You asked if I use the scanning engine, and I use our scanning engine at least once a day, if not more. Certainly part of my weekly process is very much built around the scanning engine. And I would say one of the things that I run every week, usually midweek, and I do this because I write a report for my Market Misbehavior Premium members using this scan as the foundation for that discussion. And I look for stocks making new 3-month or 13-week highs, 65-day highs, and then new swing lows. And the syntax of the scan is actually incredibly easy if you're familiar with our scanning engine. And if not, This line right here, line number 3, is the most important one. That basically says the weekly close, the current weekly close, is greater than last week's 13-week maximum close, right? So look at the last 13 closes, and I want this week's close to be higher than the last 13. That would be a new 13-week high based on the weekly data, and that's what I run. I have a daily screen which does the same thing based on a daily chart, and it's stocks making new 65-day highs or 65-day lows, which I'll show you in a minute. But this is a scan that I run, and I literally go in every Wednesday or Thursday. I run these scans. I look at the results. I dig through the charts. And what this tells you is a lot of times these will be names that are actually earlier on in their move, right? So it might not be a stock that's been trending higher for quite a bit. It actually could. So names like DoorDash and GoDaddy, of course, are popping up because they've already had some pretty significant runs. But also something like a Walt Disney, which is, to be honest with you, maybe just early days on that move higher. It's gapping higher today, but this was actually popping up on my 3-month high scans earlier this week and last week because we were just getting above that November high. So recognizing a little earlier in the move and then looking for a name like this and seeing the opportunity or the potential for a gap higher on earnings at the end of the week, that's why running this scan midweek for me for years has been really, really helpful. Last thing I would tell you is do the scheduled scan. So once you have a scan that you like, you can actually schedule it. So if you go to the scan workbench, you have this section called schedule scans. Every day, I have a series of scans that Stockcharts runs for me, and then it emails me the results. So at the end of every trading day, Stockcharts is telling me stocks making new 3-month highs, stocks making new 3-month lows. The same thing with the universe of ETFs that I've set, and literally every day of the week when the market's open, it sends me an email, and I review that list every day. So between looking at the stocks on the move, running scans when I'm just looking for names that are moving, and I showed you 3-month highs and lows, but could be MACD buy signals or RSI overbought and oversold. If I'm looking for particular types of names, that's a good way to do it. And then once you find something you like, use the scheduled scan feature to just be spitting out those results every day, every week. That's what Grace and Rose and I do, and that's how we find a lot of the great examples that we're able to share with you here on Stockcharts TV. That was a lot of fun, some really thoughtful questions, and as always, our mailbag is always hungry for some more questions from you. So if this spurred your thinking, if there's something that's been bugging you about stock charts, about technical analysis, about market dynamics, or particular tickers that you're looking at, we're an email away. The Final Bar at Stockcharts.com is where you want to send your questions, and we'll look forward to hearing from you soon. For Stockcharts in Redmond, Washington, I'm Dave Keller. Have a fantastic weekend. We'll see you again next week for the Final Bar on Stockcharts TV.